Weekly stock market update, friends. Let's get right into it. I'll make myself a little bit smaller so you can see me very clearly over here. Okay, this is the public redacted version, but nevertheless incredibly useful. We're going to start off with some of the politics first and foremost, kicking off with that. Earnings are still beating expectations. That's a balancing act. How do stock prices move? When expectations are low, i.e. people are miserable, if profits still jump that lower hurdle, prices can go up. It's phenomenal, but it happens. Equally, if expectations are really high because the market's buoyant, then it's harder to beat those expectations and prices can fall. It's the paradox of investing that when times are good, it naturally puts an equilibrium into the system that you should expect worse times because expectations have got too high. And similarly, when times are really bad, you should expect a cycle back to the upside because it's about expectations and human nature. Now, if we could all create some kind of conspiratorial get-together and collude, then we'd always manage our expectations, always just exceed those through earnings, and the price would endlessly go up. Capitalism doesn't allow collusion. In fact, it's a criminal offense. So earnings good, that is good. It's why point number 6, the S&P is at all-time highs. Point number 2, China tariffs. There's going to be talks in Malaysia between the Americans and the Chinese. The concern regards rare earths, which the Americans are desperate to have. So the Chinese have got their foot on the throat of the Americans on rare earths, for which, well, the Americans concede on some of the tariffs to change the trade balance. They'll come to some kind of agreement. I've lectured at the University of International Business in Beijing, and the one thing that came to mind from all of that period is the Chinese care about social order because they're communists. And for that reason, they care about growth to maintain social order, and they care about reduced inflation. Now, unemployment would cause mass social disorder in China. They can't afford unemployment. They need the Americans to keep buying their goods. So for them, it is not about principle. We know this because they're a capitalist communist country. It is about growth. So I suspect the Chinese will continue supplying rare earth magnets for American F-35s. And along the way, what will happen is that the Americans will come to some reduction in tariffs to manage their trade balance because they care about the trade deficit they've got with China for both principled political reasons and to a slight extent economic reasons. Oil, the new sanctions on Rosneft and Lukoil mean that there's been a bounce up in the oil price. And I'm going to show you this, a 5% rise. That is significant and that is important. What that ultimately means is we could, going into the Northern Hemisphere winter, have a cost of living crisis as oil starts spiking higher. If we look at oil, Europe, Trump tariffs, all in one go by looking at what's happening in the markets, that becomes a slight problem. What's happening with oil does indeed become a slight potential problem. Not yet to knock the markets off highs, but I'm going to keep an eye on it. It is a canary in the coal mine. The other one is the default of regional banks in the US. Slight worry, not big enough to take action yet. Consumer price index, will that mean rate cuts in America? Yes. In the UK, no. S&P rally for now, that's a good headline. That continues higher. Do we have a worry about any of this in terms of decisions we need to make today? No. Supermicro, down 8%. If you own Supermicro, you're used to that kind of volatility and you probably won't panic. Intel, Palantir in the news because of contract wins. Tesla I don't own because I don't like that it'll need the volatility. We'll come to some of those stocks in a moment. Okay, any of these impacting our concerns about the stock market? Well, stocks are actually climbing, oil prices are rising. We see the oil stocks are, and Intel beating expectations helps that. Private equity is a big story. It doesn't concern us because private equity is not something you're going to directly invest in, and we're not going to speculate on trying to get you into that area. Gold, I keep hearing positive things about. 5% of your portfolio in gold in good or bad times is fine. If you want to do more than that, you're really gambling and speculating, which is entirely up to you, and it might continue higher. But what I'm hearing from the private banks and also from people in the know is that demand from central banks, from consumers, retail investors, following the trend, and also from exchange traded funds, that's set to continue for now. Do I need to make a decision when it'll end? Today? No, I don't need to make that decision today. All these other things, useful, interesting, but they don't really make a difference to us, as in any decisions we need to make today on our holdings. Now, equally, going on to say the CNBC side of things, they tend to be a bit more breathless. Nothing which makes me think, right, we've got some red flags coming up. Okay, job layoffs, we're hearing a lot of that at the moment, partly because of AI. It really usually means earnings are going to be protected, and that's good. If earnings are protected, that's good news. S&P higher, not bothered about beyond meat. What about any of these? Well, Molina falling again, healthcare getting a bit of a battering yet again because of this government. Fundamentally, the question is, are the companies sound? And we'll look at some of these in a moment. The AI issue, side show, AI is going to continue. These guys can say what they want about not wanting super intelligence. There's enough people willing to deregulate for that to continue. Alibaba, AI glasses, $660, rival Meta, ChatGPT challenger. Alibaba stock is volatile. It's one of those that comes up on our radars, but it's volatile. So if you can, like Tesla, handle the volatility, don't have a problem with it. But it's the volatility which will kill most people. They'll panic. Okay, so it won't be suited to most people. This point, China and India, the real problem for the stock market is if oil goes above $80, start worrying, because then that can impact the stock market. We're not there yet, so we continue taking the ride to the upside. Nothing I want to address with any of these particular stocks. We're not here to do the kind of crazy newsletter stuff. I had somebody email me today saying they had awful experience with the Seeking Alpha newsletter, and they're one of several people who email me regularly, because you're really riding rodeo horses on that kind of high beta, high good advertisement, good marketing thing in the short term. Right, moving on to the individual stocks. This is not a solicitation to buy or sell any particular stock, and it's for your education. Before we get into the stock market, I found this, which was very worrying. Just the poor performance of these funds. This is going back over the last, I think it was 5 years, not 3, over the last 5 years. These are household names, which is what worries me. Scottish Widows, Aegon, Standard Life, Zurich, and the like. Name as well, it's an annuity fund. But seriously, 25%, losing a quarter of your pension? Oh no, you're safe in annuities. Really? Oh, don't worry, you're safe in bonds. Well, not if you lose a fifth of all your money. Oh yeah, that's why you should be in equities, 70% equity. Well, wait a minute. No, they've managed to lose your money in one of the largest stock market rises. Well, you can't compare each with each other. People are making excuses on losing money, but it is worrying. Characteristics. Okay. What do you find? Phoenix MPI pensions returned 93.7% over a decade, lagging peers in its sector by over 50 percentage points. Basically, you think that's a lot, doubling your money in 10 years? No, it's not. It's actually really poor. Quilter Investors, Cerulean Moderate Portfolio. Where did they come up with these stupid names? Showed losses of 0.3 over 3 years, returns essentially run out over 5. 17% over 5 years is really bad. And you can see they usually are worse than their peers, or they underperform against a benchmark. Okay. LNG, higher average annual cost, more than average annual cost, the cost that they charge people. Again, I'm sorry, I'm in the way constantly with this, aren't I? Okay. Anyway, let's get into the S&P and why, therefore, I like people to be buying and holding their own stocks and the reasons for it. So let's start off and see if it's something which people could do. You open an account, SIP, an ISA, or just a direct investment account. You put a ticker in and you say, I want to buy $10,000 or not, as the case might be. That's straightforward enough, rather than give it to a fund manager to do exactly the same thing and mess it up for you. So where are we on the S&P 500? Well, of course, we're at an all-time high. The real issue is, given that we're here, okay, and the average price pattern is looking very similar to what it did here, are we about to get a short, sharp fall? And if we do, when that happens, not now, but when that happens, do we exit as soon as possible, even though we might have to buy back more expensive later? Or do we exit as soon as possible because it might turn out like this, which it also looks like? Or alternatively, do we just sit through it on the basis the sharp short shock will be indeed short? Or do we not sit through it because it might be prolonged and it would have been better to have exited and not had death by 1,000 cuts? Or alternatively, if you think of it, when decision making, it's always useful to think of things in a sliding scale or a binary decision. In a sliding scale, you might say, well, actually, I'll exit half, keep half when and if those falls start. They haven't started yet, so keep watching these videos, subscribe and follow and like and all the rest of it. We'll make it then. But where are we? We're here. Now, could it continue going up? Well, that tends to happen less frequently. And even if it does continue going up, we're going to get some kind of a wobble first, just as we did there. So be braced for it. Decision to be made today for me, because there's only 3 decisions, buy, hold, or sell. I don't see a reason to sell today. Would I buy more at the moment? No, I think I'm happy with how much I hold, given how overbought it is, so I continue holding. Simple. Okay. This is the daily chart of the S&P, the 500 largest US companies, but the index is really an index of 7 companies, which are the large, big Mag 7, you might say, which, the 2 M's and the 3 A's are in there, and NVIDIA, Meta, Microsoft, Apple, Amazon, Alphabet, NVIDIA, and you throw in Tesla as well. So that is very similar to that. So in the near term, of course, I am expecting there should be some more downside, as are the investment banks, because statistically, it is due. Now, you might say, well, hang on. You could throw 10 heads in a row and say statistically a tails is due, but it isn't. It's got equal probability of going up or down. It's not the same. A coin has no institutional memory. The stock market does. So these are conditional probabilities, not independent ones. And therefore, if you've had 10 heads with the stock market, 10 bullish runs, you are more likely to be due a fall than you would if you had 10 heads in a row. Probability and statistics, thank God I did that at A-level maths, are very important things. You only need it up to A-level, to be honest. Now, what are the earnings? Well, we've got a ton of earnings coming out. You can see all of this. We've had a ton of earnings already, which haven't decoupled the market, which is good news. And then we've got some more on Friday, Monday, next week. You can see all of this coming up. Ton of stuff. United Health. Any of these miss their results, and we've got a problem. Okay, if they miss their expectations, they will drop. And I'd suspect they'll drop 10 to 15 to 20% if they miss their earnings. Which ones are likely to? I don't know. If I did know, I'd be going to prison for insider trading. Okay, and then you've got a whole load more coming. So we're very much in earnings season. Be ready for it. What's the past week been like? Oh, a lot of green. Nice bit of market stability, given everything else going on in the world. What about the past year? Well, the past year has been phenomenal, other than some of those healthcare companies, which it's not that. I mean, think about it. These healthcare companies have fallen, so have some of the biotech. Is that because suddenly all healthcare and biotech companies are rubbish? No. Is it because there's been a change in government policy? Yup. Are the companies being run well? Well, it wasn't management problems. It was changing policies. Therefore, we should see that they won't forever perform poorly. But it's not something I'd be looking to buy into at the moment. What's interesting over here is my JP Morgan holdings have done better than my Nvidia ones. Surprise, surprise. And my Goldman Sachs ones have done better than my Nvidia ones. You wouldn't have thought that. It's why you have a portfolio, not an individual stock. Over the past year, the Nasdaq's up 23%, UK 18, which is unusual because the UK doesn't usually outperform the S&P, but it is presently. It won't last, tends not to do it. For those of you who are futures traders, shorting the UK and going long the US would be quite a sensible move. Now, got to get the ratios right. What's interesting about all of this is that's when people panic, and these prolonged periods of sideways move is when they get bored. That's why people don't get 23%. Hey, Alpesh, I didn't get 23% in NASDAQ. Did you panic and sell out? Yeah. Oh, did you sell out because you got bored? Yeah. Oh, okay. That's the reason why. It's why with investing, you should have a mentor. You will know if you follow my public broadcast. I've said it publicly many times. It's not an official secret that I own all of those. I don't have that because I don't want the volatility. I have in the past. I just don't want the volatility. I do that almost to make a point to people on my program, although this is a public broadcast, that it's okay to say no to things which you think might go up. Okay. And it's not just because of that basically you're paying $250 for every dollar of expected profit. With Meta, you're paying $25 for every dollar of future expected profit. 26, 33, 40 in the case of Apple. But Tesla, you're paying $250. Now, he might create a time machine, might Elon Musk. So that might be justified. Okay, but at the moment, it's a bit of a problem. UK, I will cover separately in a broadcast. Where are we on the NASDAQ? Now, what's interesting here is when you look at the average prices, which is measured by the moving average convergence divergence, and you see the all-time highs. Notice how when you get this overbought scenario, okay, usually there's a drop in the price which follows it, as you saw there, as you can see here. So a degree of a drawdown and a duration, you're underwater. Drawdown depth and duration, okay? Similarly here. So that's 1, 2, 3 times. You could potentially argue 4, maybe even 5 where it went sideways. Okay, so 1, 2, 3, 4, 5 times. Could it be that this breakout, which has happened, is the 1 in 6? Now, it looks it. The point I'm making is the probabilities are very much stacked in favor of saying when that happens, this kind of look, it's more likely to fall, although there is a slim possibility, 1 in 6, it might rise. And indeed, this time it has risen. Will it continue? Well, that downward pressure will at some time hit it. So I'd be cautious with the FTSE 100. Whilst I own this 2 times leverage exchange traded fund in the S&P 500, it is overbought. The same analysis applies to this. There is probably only a 1 in 6 probability it will continue up. However, I do not need to exit prematurely. I will exit when that happens, here, if and when, and probably even possibly before, if it starts falling, and this is falling as well. Just so maybe exit 50% there, and the remainder when you get the crossover there. Of course, it could be a short V-shaped, in which case you end up going back in when this starts rising again. Alternatively, you could sit through it. The danger if you sit through it, which I do not recommend, is a long, drawn-out period of being underwater. At the moment, I'm holding. Would I buy more? No, it's overbought. Would I hold? Yes. Would I sell? I don't have a reason to at the moment. Very simple reasoning. Okay, crisp, clear. Now, where are we on this? Well, we could be about to get a fall. We don't know. We've had this play before where it looks like it could be prolonged, but in fact becomes V-shaped. So we don't have the holdings. I don't have an issue with it. But this is what I want to show you. These are the return histograms. So statisticians looking at the stock prices. Now, over one day, there is a 9% drop, but very small probability. The size of the probability times the size of the drop, okay, equals how much you'll panic, okay? Bigger the probability of a big drop, you'll just completely panic. Small probability, sorry, Small probability of a big drop, you'll panic because it wasn't expected. Small probability, and yet it happened, and it was a big drop, you'd panic. But look what's interesting. Over 5 days, it can be 14. Over 20, it can be 20. Over 32, over 50 days, you're down 32%. You're really starting to worry. However, we know typically you get a positive return. This is why the dip buyers come in. They don't know this is the pattern. But if the pattern looks anything like that, you'd be buying on dips. That's an essential characteristic of the Quality 5 Plus companies that we have, the 44 companies that are in the we call the Quality 5 Plus portfolio. Now, of those 44 companies, they'd have to have characteristics like this, which when they fall, it would make sense to buy as opposed to sell if they fall, okay? Because in the latter category, you'd expect further falls. Applied Materials, for instance, is an example of a company, room to grow, to go up, the type which, were it to fall, I'd be more inclined to buy more than to sell. You might say, well, what about during this period? Well, they're also, when they're of that nature, the types of companies where if they're in this daddy bear scenario, you've got an option, either go 100% into cash, or because they're good enough, you can keep buying if you've got the stomach for it, i.e. buying as they go cheaper, on the basis that as they rise, you make your money sooner. But that's a very select group. This on our value growth income rating has a rating of 7. Okay, so undervalued, high growth, dividend yielding. So there's a limited number of companies we can do that with. This is one of them to give you an example. And you can see here, and yes, you can have that. So one of the worst cases, but still makes sense in the portfolio to be adding on the basis that you're more likely to have a move forward. Not as good as Amazon. Apple and Microsoft are some of the best at this. I'm going to show you time travel back to 2023 and do the review from my slides from 7th of April, 2023, which I happened to be looking at it while they came up as I was scrolling through stuff. And this is the closing price of the companies that I mentioned. I'll show you the companies in a second in the ticker. Now, of course, we've had a bull market. I can't take credit for that. There has been, we've ridden the coattails of that. What I want to show you is, had I known from back then, that webinar that I did, that these two were going to go up this much and these, I would only have picked those. So think about it. I didn't know that. I didn't have a time machine. Had I known these were going to fall, and some did fall, like these, I wouldn't have named those either. This is why we have a portfolio. Okay. And in case you're wondering, yes, it's better than the S&P, obviously. Had I known, oh, by the way, Temple Sealy corporate action stopped at that point, as it were. So let's have a look at what we were looking at then. These are the charts from 7th of April, 2023. Basically, that's what it looked like. And you can look at the data and how well it's did. And here the argument with it, this is exactly the charts from there, I'll just move them here, was it'll stay within this and should continue doing that. And indeed it did. Again, the argument with Alphabet was, look, guys, it's broken out and should be continuing upwards. Okay. And that was a wonderful time to be involved. Similarly with Microsoft, after this long 2022, it's broken out, should be moving earlier. This was actually, in fact, an update on earlier purchases that it wasn't April of getting in. Actually, getting in was earlier than this. This was an update on it. Amazon, fallen out from there. More importantly, this looks like to be flattening and should rise, and that was the projection. Of course, all of these achieved it. I think PayPal didn't. PayPal had fallen off. My point was it's volatile, can still stay down for a long period of time. Didn't do that. Just goes to show, didn't do that. In hindsight, it looks obvious it wouldn't, because look, it's just flatlining and would stay around here. And indeed, it has. Adobe, similarly, I think it disappointed as well. It didn't sort of go up in that projection. So, and you can see what had happened in 2022 to a lot of these companies and hadn't necessarily resumed upwards after. Trimble, okay, and again, the argument with Trimble was made. That's where we are, overbought, should be rising up. Similarly with Disney, I'll show you the returns again in a second. Taiwan Semi, of course, blew the doors off. Nvidia was one of the best, you might say obvious. Well, actually, what was obvious was after it bottomed out here around there-ish and then started bouncing up. Now, we only projected 116% over 12 months. It obviously did that and then went continuously the year after. JP Morgan, one of the ones I've held since then, and of course has done incredibly well, and in the past 12 months better than Nvidia, of course. Brunswick, and you can see the similarity of patterns. When you get the similarity, and similarly if it was up here, all of them doing this, that's what made it easier to exit in 2022, and it made it all that much easier to enter with conviction in 2023. Okay, Hibbett, we'll look at it in a second. Tesla, this is all from there. I do remember doing this analysis at the time, and I can't remember what I said about it. But anyway, the projection was it would do incredibly well over that period. It wasn't too bad. ServiceNow, so we'll go back to these in a second. But you can see how that pattern had reflected in so many falls and then rises up, and 88% is what we projected. So in a way, we're happy when the markets fall. JP Morgan, private bank, said that they want them to fall. It's about time they do. It'll be good for the markets. Yeah, it'll be good for us to redeploy capital there. We'll just exit on that little daddy bear, redeploy there and ride it up. Is that about to happen? No, I don't know if it is. Live Nation, I'll look at the results again. What happened? Did that actually do that for us? Similarly with global loss. Put a stop loss for clients who are interested in this. Sorry, global payments. First American, quite a few. I'll just show you those results again. Comcast and the projections. Let me just show you. I haven't finished yet. I've got a bit more to show you. Comcast, Global Payments, PayPal, Adobe, Brunswick. So those were the worst. Disney, not good. Equifax, not good. What do they have in common? Well, difficult to say what they have in common, other than we did the analysis and we did well. What was also healthy for us wasn't just that, of course, there were a few outliers, but there was a lot of good middle order performers. If you're into cricket, the middle order in batting, obviously the tail end got screwed, weren't bad. Now I want to show you something else. I'm going to show you some, I want to show you some tools that I've created, which are incredibly good and incredibly important for people, to see. And I want to show you these because they're very, very, very popular. And they're free, campaignfor1million.com/tools. And we've added 3 more, including a lifestyle calculator. And if you look at these, what they'll do is you can put in your current age, retirement age, contributions, and whether or not you're likely to be able to withdraw as much money as you want, and whether you meet the definitions in the UK and US of a comfortable retirement. How useful is that? Okay, gets better. Pension age. You can upload a photo of yourself and it will tell you whether, based on your age, you are on track or below average or above average in terms of how much savings and pension you have got. The FIRE tool will be of interest to maybe the younger ones. Be financial independence, retire early. Depending on your age, the goal, you play around with all of this, current amount, your target amount, and by when you want to reach it, and it'll tell you how close you are to getting it, and whether you're on target or not. Not to be missed is the more complicated one, which is really important if you're closer to retirement, the portfolio stress and sequence of returns calculator. This works out, what if you get a series of bad stock market outcomes while you're withdrawing capital? And what this has done is shown you what would happen. And also the probabilities you're going to run out of money depending on what you've got and whether you're not. So you've got now the ability to work out with these tools the probability of running out of money based on your assumptions about withdrawals and your growth rates. And also you've got the ability to look at what kind of lifestyle you want, whether it's achievable. And I'll tell you the outcome of looking at all of these apps that we created. It was that the most important and easiest thing to change is the growth of your money. And if you manage to get on top of that, then you can hit all the other goals. That was the easiest thing to change, and probably the most important thing that was out there that we would suggest people actually changed. And like I said, it's quite interesting because you'll be able to compare yourself to people as well. So I wanted to show that to you all. I hope you find that useful. But also, any questions, let me know. Do like, follow these weekly updates for more. Have a look at campaignforamillion.com/tools. We've also got a new thing where you can have a free educational tool. It's part of our campaign to teach 1 million people how to invest better. So do have a look at that. You'll be able to plug into the calendar directly for a free call on there. And you can always, if you don't want to put it in there, you can email us, you can directly call and so on. And also before your call and after your call, there's various tools and useful things that we provide as well. What I would say to you is have a look at the articles. We've got some really, really great articles on here. And what these do is they will give you a really good idea. 3 days ago, 5 days ago, so they're bang up to date. I'll give you I've pinned these 3, by the way. When you look at these, why growth is the real engine of financial independence. So when you look at these tools, we've actually worked some examples for you and worked out why if you make growth increase by even 1%, how it's a lot easier to have superior returns over the longer term, and significantly large ones at that. So I would say that. And also one other bit that I want to draw to your attention, we've analyzed people like Fundsmith, L&G, Aegon, St. James's Place. So you look at Fundsmith, for instance, this is the level of detail we've gone into. What are their returns? And we looked at the last 5 years, and they've generated about 5% per annum. And then we've looked at them, 5.8% is them compared to other routes. And then we've analyzed why have they been such poor performers compared to others, and broken it down and explained it. So we do quite a bit of in-depth research into individual funds. Our goal is to empower people and to give them the confidence to invest themselves. I hope you found all that useful. I should have shown you the screen while I said it. Here we go. Campaignforamillion.com. It's over there, the retirement calculator, pension lifestyle calculator over here, and it shows you what people can do. And over here, the calculator, all of those are great in at campaignforamillion.com. What's safe to withdraw, portfolio stress test, as I said, all free and with really user-friendly interfaces you can play around with your age and what you think your growth rate will be and so on, and calculate whether or not you're likely to have what you're looking for in terms of retirement or not. And you can see the numbers change right in front of you as you play around based on how much you think you want, when you want it, and whether you're going to hit those goals or not, as well as this one, which helps you, you upload your photo and sort of tell you. Okay, we've also got, as I said, the lifestyle calculator, which tells you whether or not you're going to be able to meet what's called a comfortable or moderate lifestyle. And we've got the numbers of what that means in the UK and the US. So do have it in life expectancies and so on. Okay, so do have a look at those as well. Okay, thank you very much.